All right. We got a good little crowd here today. Thanks for joining. Good to see everybody this morning. I'm going to try to hit on three different things today, and I'm going to move kind of quickly through some numbers, hopefully trying to focus in a little bit more on the third piece of what we're going to look at. And I'm going to start with a screen share. This is a chart. So the chart you're looking at, this is the same numbers that I've been highlighting about on average about every 3 weeks going back to the end of June. And I really wanted to highlight one specific thing. I know this is we looked just 7 days ago at this same data set. So this is, again, single family houses in Indianapolis. That first chart is pendings, actives, and how many have closed in the last 30 days. And as you can tell, the number of pendings and the number of houses that have closed in the last 30 days, they've been on a steady decline since the end of June. So they basically had your pendings at about 2,000 at the end of June. They're creeping towards 1,000 right now. That's as of this morning. Your actives in June were 1,287. They're now at 2,044. So obviously we saw those two numbers cross each other, right? So the end of June, you had notably more pendings than actives. Now you have notably more actives than pendings. And just, guys, as we've talked about, it feels odd to have more actives than pendings. But that has been our market condition for the vast majority of the last couple decades. It's just in the last 2 years made that feel strange. I do want to point out, this is funny. This is like me admitting my prediction was wrong, but yet saying I was close. In October, I said that I think one of these numbers by Thanksgiving would make some sort of a turn, that we would see like a new trend. Either the pendings would come up, the actives would come down, or the closed in the last 30 days would come up, kind of breaking this trend that we saw since the end of June. I was wrong. It did not happen by Thanksgiving. However, as of today, the actives have actually crept down. So you notice this is the orange line here. For the first time since June 29th, there are actually slightly lower inventory of single family houses in Indianapolis than there was a week ago. So I wouldn't make much of that. It wasn't a huge decline. I mean, it's down by 60 houses basically. But worth noting, it looks to me like what was a pretty significant shift in pendings and actives. So the kind of rebalancing of our inventory happened pretty aggressively through July and August. This is this area of the chart, and then has been on a pretty steady rate since then, which, again, just coming back to this, that is what is happening here through the end of September, October, November, very normal for our marketplace. I would say the same thing about days on market and days of inventory, which is this second chart. So we were actually just talking about this in our team meeting yesterday. Kate, this is the 31 number there that we highlighted. I think this, if you're looking for kind of one indicator of what's the market doing right now in comparison to what it was doing when things were crazy, this is it, right? So the fact that at the end of June, the last 30 days of closings, those houses had been on the market only for an average of 11 days. That's what makes the fact that we're now at 31 feel so slow. So that number keeps going up, but honestly, it's got a ways to go before that would indicate a shift in leverage to make it like what we would call a buyer's market. All of this still says that single family houses in Indianapolis are a seller's market, just not quite as much as they were a couple months ago. Second thing I want to reference is mortgage rates. I think it's obviously been a key topic of conversation. Mortgage rates are one of those things that We look pretty hyper specific in Indianapolis at housing data, but mortgage rates obviously are national. It's a national marketplace where housing is not. But I think it's worth noting that with all the volatility we've experienced in mortgage rates over the last 2.5 months, we have seen a bit of a decline in mortgage rates. So this chart that I'm looking at, just FYI, as you're looking at this, please note that I have the credit score set to 800 and higher. So this is like your premium borrower with 20% down. But nonetheless, the fact that high credit borrowers right now are getting 30-year money at 6.7 and 15-year money at 6.1, I think the market had actually started to find an equilibrium with rates in the sevens. And so who knows what the next couple of weeks are going to be, but I think this bodes well for early 2023 activity. So if you think about the mentality of a buyer, a lot of economists have been talking about how many buyers left the marketplace, just put things on hold because they've been looking and looking and looking. All of a sudden rates are at 7.5, and kind of come back to this little paragraph that I have here on this chart. The household earning the median annual income of $71,000 using 20% down could afford a home at $448,000. So in January of 22, a median income buyer in the United States could buy a $450,000 house because rates were at 3.1. Okay. A 7% mortgage rate means that same household can buy a $340,000 house. So think about that from January through the early November, that 10 months, the median buyer in the country went from being able to buy a $450,000 house to a $340,000 house. So that's obviously a big impact. But I think it's a sign of encouragement that rates have now started what looks to me like a slow and steady drop, which again, who knows, but the mortgage lenders that I talk to have said they think this is going to be our trend for a little while, is these like very small incremental drops. The theory there is that the Fed is trying to find an equilibrium where the economy is active and the housing market is active, but not like gangbusters with the inflation concern. So basically, they had an inflation concern that they had to raise rates to try to fix. It appears that that's worked. And so now I think they're going to try to like slowly inch them down to try to find where is that equilibrium. Again, I'm not an expert on this. And even those who are experts, when they try to predict what's going to happen, they're often not right. But I think this is something to be encouraged about. Particularly if we see this downward trend continue and that kind of like matches up or hits the stream with what sort of activity we normally see in January. So just as a reference point, January 1st and 2nd tend to be some of the highest online searching days of the year for housing. So you think about the mentality of a buyer being, okay, I know I'm going to do something in 2023. Those first couple days are really common days for them to jump onto their laptop, their phone, probably on Zillow, and start doing some sort of searching in preparation for something they're going to do later in the year. So I think if we have these streams hitting at the same time, one stream being this kind of slow drop in interest rates, which makes things more attractive for the buyer. And then also the normal pickup in activity that happens in early January. I look at all this and I say it feels pretty normal. Like it feels a lot like what was happening in 2014, 2015, 2016, these years that we didn't have gangbuster pace. We weren't seeing a ton of multiple offers, but they were really healthy years in our real estate market. And we were celebrating. And that the September, October, November, December, the fourth quarter of the years prior to all of those felt very slow, and no one seemed to be concerned about it like they are now. So it's just interesting how the same sort of data happening today has this kind of raised temperature of concern. Okay, third thing. Thanks for bearing with me as I'm going fast through here. Shout out to Tatum Hill. Tatum sent me this article, and I thought it was really fascinating. We'll send this link out with the video of this recording. But I think this is a really interesting thought piece. This is from this guy here, John Mack. He's a real estate consultant that works for John Burns Real Estate Consulting. I wasn't familiar with him, but I thought this was a really interesting analysis. So I'm going to start. This is the bottom of the article. I'm starting here. His view of the housing market is that you could place every metropolitan market in one of these 6 life stages. So, and it functions on a cycle. So
hey, Mark.
Yeah.
Your screen hasn't changed.
Huh. I'm going to stop the share and try it again. Thanks for giving me the heads up there.
I think it's your internet because it's still moving for me.
Okay, is that showing up? Okay.
Yeah.
So we see these 6 phases. So the theory here is that all metropolitan housing markets are going to fall into one of these 6, and that they just tend to go in a cycle from recovering to growing to plateauing to slowing to falling to bottoming. And that once a market bottoms, then at some point it starts to recover and then grow and then plateau, and that they go in these cycles. And I think he's trying to compress, thousands of variables into a simple model, but I think it's helpful. But the one thing I wanted to highlight here is how he categorizes Indianapolis. So here's another visual of his view of real estate in these housing markets and how this cycle happens, right? So here's the circle. And he puts Indianapolis into the plateauing category. And you notice probably some patterns here in terms of what cities fall into plateauing, what ones fall into slowing, what ones fall into the falling category. One of the variables is that a lot of these in the falling category are A, very high priced, and B, have experienced price appreciation at a more radical pace for a longer period of time than we have. So think about markets that are A, higher priced, but B, they have seen 15% plus year-over-year price appreciation for a longer period of time than Indianapolis has. Phoenix is a good one. Phoenix is here in the falling category, more than double our median price. And they've been experiencing price growth for the last 5 years, like we've been experiencing for 2. Okay, so just kind of interesting to see where he puts these cities. But I wanted to highlight one particular sentence here and talk about this for a second. So I'm reading right here under plateauing. Markets in the plateauing phase have seen significant capital investment over the past 12 to 24 months. Check, right? We all know this is to be true of Indianapolis. Indianapolis was on every top 10 investor list, where to park your money and housing list that we see anywhere. Indy fell, seems like, on every one of those. We saw all the private equity money kind of in second half of 21, early 22. So for sure, we've seen that significant capital investment over the last 1 to 2 years. So now reading again, and are now faced with limited volume growth and decelerating home price appreciation. So that's a it's a mouthful there, but limited volume growth. It's interesting. I just think both of these is limited volume growth and decelerating home price appreciation. You have to really think about both of those descriptors because you realize that limited volume growth still means volume growth. In terms of what he's predicting is that the volume of real estate transacted in Indianapolis looks like it should continue to grow. Perhaps just not quite at the same rate. That's why he's saying limited volume growth. The second one there, the decelerating home price appreciation. That is like something that a financial analyst or an economist would say, but I don't know. I feel like I've read so many things recently that are going out of their way to use terms like deceleration or slowdown or decline. At the top of this article, we'll send it out later, and if you read it, they'll talk about, they have 10 indicators for a bubble bursting, and they think that nationally 8 of the 10 are now true, but not necessarily in every marketplace. And so they use that word bubble. But I just want to point out that in these plateauing markets, what this analyst is saying is that prices should continue to appreciate. It's just that the rate of their appreciation is going to be slower than it's been over the last couple of years. And I would say, well, of course, like I don't think anybody thought it was sustainable or even preferable, right, for our prices to keep going up 15, 16% a year. He does note here, he says Atlanta, Charlotte, Indianapolis, Orlando, and Tampa. It's a really kind of an interesting cross section of cities. We have a lot in common with those cities, particularly Charlotte, Orlando, and Tampa. They've experienced significant home price appreciation, in migration, meaning our population is growing relative to our kind of peer communities, and job growth during the pandemic. So this is prompted by buyers seeking out their life is more fluid. They could maybe live wherever they want to. And so they're seeking out affordability. And so those cities tended to be winners. Obviously, Indianapolis was one. Then it says, conversely, higher mortgage rates and slower economic growth have caused buyers to drop out of the qualified buyer pool or pause their home search until there is less uncertainty around the economy. I think it's the last point that I'll make. But you notice in that paragraph, when he's talking about cities like Indianapolis, he kind of gives one highlight and one low light, right? One thing that has positively impacted our marketplace, one thing that has now negatively impacted, slowed that growth. And what I find interesting about those two things is that you notice the positive one is not a national factor. The positive one is something that is somewhat unique to Indianapolis and cities like it. You follow me on that? That we've experienced significant home price appreciation because of a net migration gain and job growth. That cities like Indianapolis, and this is definitely true of Indianapolis, are seeing relative population gains. In other words, relative to a lot of the cities that are on that slowing or falling list, our population is growing and our job market is growing relative to those. And a lot of that's to do with affordability, the affordability of a business locating here, the affordability of an individual locating here. And then the converse, the negative, it says the thing that is slowing this market, higher mortgage rates and slow economic growth, both of those things that he's talking about are broad national factors, not at all unique to cities like Indianapolis. I look at data like this and say, this bodes very well for a market like Indianapolis. So you kind of have the local and the national, like what's happening nationally in terms of interest rates and the economy affect the housing market, and it will affect the housing market everywhere. but then every city has its own unique set of factors that are going to uniquely affect that specific marketplace. And I think there's a lot of reason to be optimistic about how Indianapolis is going to fare relative to the national housing market. It certainly has been true recently, but I think one of the highlights of this analysis in this article to me is Indianapolis should continue to fare favorably relative to the rest of the country in its housing market, even in the middle of what might turn out to be a downturn. So I think there's reason to be optimistic, and recognizing that those national factors, interest rates, economic growth or shrinking, they tend to be more predictably cyclical. In other words, they're always going to rise and fall to kind of create or slow down demand. But as that happens, Indianapolis should fare well both in the up and the down of that. So I know there was a lot there. I'm going to send out this article with the video. Y'all get that later today. As always, I would say trying to keep up and be informed on at least the basics of what's happening is a really good way to add value to your clients. I saw, I was cracking up about this. James Krause, if some of you know him, I know James is a realtor here. Shout out to James. I saw him make some pretty funny social media comments and posts about how many times he was asked about the housing market over the holiday, like being with different groups of his family or extended family over Thanksgiving. He kind of had become the person that they're all like, James, tell us what's happening in real estate, because everybody wants to know. And I think as realtors, we should look at that as an opportunity. Like right now, housing is just a popular topic of conversation. And that's a chance for you to demonstrate your expertise, to add value into somebody's life. And so be ready for that. Have kind of your talking points. And I know, some of you are going to nerd out on this more like me. Some of you are going to say, oh my gosh, there's 100 things I'd rather do than dive into this. So for those that aren't necessarily as into the numbers side of our business, the one piece I would highlight, if you can remember one thing, it's this column right here that I've highlighted. I think that's a really concise data point that you could utilize in conversation with someone saying, how's the market? You'd say, well, by June of 22, houses that sold were trading hands on average in 11 days, and that's insane. Right now, they're trading at 31 days, and that feels really slow, but that's only because we got to 11. And the 31 days is actually considered a seller's market and predicts that we should see prices to continue to go up. So that kind of would be a good highlight for Indianapolis. Okay. I'm not who from ever in to ask me that question. I'm not going to dive into that prediction. I don't know. Is that a fair answer, Chris? What do you think, Chris? Do you have a guess? Chris says no, it's not fair. Chris, what do you think?
I had a lot of people, I have already ran into a lot of people today, and they've already said, oh, this is a big day for realtors. So I honestly had to Google why it was a big day for realtors. So Powell is the is the chair, I think, of the Fed, the United States Federal Treasury. I don't know. My take on this, Chris, is that there are no like single big days for realtors. I mean, I know what they're saying. If interest rates go up or down, it clearly has an impact on our business. But I think that's like a hyper focused in short-term view, personally. When you zoom out enough,
over like cycles of years, the business is kind of the business. Like the amount of volume and transactions that take place tend to like water finds its level kind of thing. So I don't think it's that big of a day for realtors. Okay, if I had to guess, I think rates continue to go down. If I'm wrong, the next time your team has Irish car bombs, I'll buy them. How's that?
Deal.
Deal. I was probably gonna buy them anyway, so that was a safe bet. Okay, we're creeping up on 9:30, y'all. I'm gonna wrap it up. I am gonna shoot out that article with the video. As always, if you ever have any questions or want me to help you think through how to talk to a client about something, just let me know. Y'all have a good Wednesday.